Good afternoon, everyone. So, welcome to eCal platform. And today we will be learning on financial leverage or trading on equity. Today's topic is that. So, trading on equity or financial leverage during board exam, it can be for a 6-marker question, or a 4-marker question, or a 1-marker question. Now, what is trading on equity? Or before discussing trading on equity, you should understand the capital structure. What do you mean by capital structure? Capital structure means every organization they need capital to start the business. Either they can issue the shares, or they can take the loan, or a combination of both. In this case, what should be the proportion of the debt and equity? Equity means on funds and debt means borrowed capital. So let's discuss that in detail. Suppose the total capital required by a company is 10 lakh. For example, a meager example I am taking. And here they are planning to issue the shares for rupees 6 lakh. Shares for rupees 6 lakh. That is called equity. Now, remaining 4 lakh, they can take as a debt or loan from the bank by issuing the debenture, whatever. So that is known as debt. So what should be the proportion? The debt should be more or the equity should be more. That we are going to learn in the trading on equity. If we take more debt, definitely company will be in risk. The risk part of the company will be very high. But if the company is taking the debt, whether it will be beneficial to the investors means shareholders, whether it will be beneficial to them or not. So that process is known as financial leverage or trading on equity. Let's discuss with 3 cases. While we discuss with any company or to know the capital structure, we have to consider the total capital and what amount as equity and what amount as debt. And definitely, whatever the business will do, ultimately the profit matters, the return matters. So let's start with the various cases. Then I'll be explaining about the EBIT versus EPS analysis. This is called EBIT versus EPS analysis. What is EPS? EPS means earning per share. If the company take equity of 6 lakh rupees and debt of 4 lakh, or it can be 8 lakh rupees equity, 2 lakh rupees debt, or it can be without debt, entire 6 lakh as equity. So these various cases we will discuss. And let's see that how the various cases will be helping us to find out the EPS. And these various cases, whether there will be an increase in the EPS, EPS means earning per share. Every shareholder, those who are investing in the company or those who are purchasing the shares, they are known as shareholders, and they actually want to get a high return. That is coming in the EPS. So let's see that EBIT versus EPS analysis. What is EBIT? EBIT means earning before interest and tax. That is company's original income. And because of that, from that we will be going into earning after tax, whether that is going to help the company or not. So let's see that there are various cases. And before taking that, case 1, case 2, and case 3. So in all these cases, company's total investment, company need the total investment as 30 lakhs in my example. Okay. So total capital, they need 30 lakhs. The total investment required is 30 lakhs. I'm using investment short form. And the company has to pay the tax as 30%. Tax is 30%. Let's take an example. Then EBIT, earning before interest and tax. Let's take an example of 4 lakh rupees. Almost the same is given in NCERT book also. You can check that. So this is the common information you are given, you are getting. And out of this, the case 1, what is the equity and debt combination? So first here, the entire is equity only. Equity means equity share capital. The case 1, that is the whole investment they are taking as 30 lakh rupees as equity only. And next case, they are taking equity only 20 lakhs. But the debt, the first case, there is no debt. Second case, the debt is 10 lakh. And third case, they are increasing their debt, that is 20 lakhs. Then the equity will be automatically 10 lakh. So these are the various cases. Let's understand one by one under which case the EPS will increase. Thus, we can decide whether in the total investment more debt is required or more equity is required. Let's see one by one the cases. I hope you are able to understand the cases, what we are going to learn. Let's start the EBIT versus or EBI from EBIT. We are going into EPS. So this entire case study, we call it as EBIT versus EPS or EBIT EPS analysis, right? Let's start one by one cases. So case 1, we are taking that first. Then case 2, then case 3. We are starting with EBIT. Any case, your EBIT, earning before interest and tax, this can be called as profit before or income before, whatever. And we use the word earning before interest and tax. In all the cases, our EBIT is 4 lakh. Because our investment is 30 lakhs. That is why earning before interest and tax is, in all the cases, it is 4 lakh. Now, from this, first we have to subtract the interest portion. This interest we have to subtract. Because the order how I have written, earning before interest and tax. First we subtract the interest, that is our expenses, non-operating expense. We have to pay that. Then only we are getting earning after tax, after interest. From that, we will have to reduce the or subtract the tax. That will be the last net profit that will be distributing among the shareholders. So let's see that one by one. Now there are various cases. So let's see one by one how it will be working. From this, first we have to subtract the interest. Okay, first we will subtract interest. In case 1, there was no interest. So we will not subtract. We cannot, because you can see that I'll scroll up. You can see the first case is only equity. Equity 30 lakhs, there is no debt, so no interest. And before that, let's assume one more thing. The interest rate, whenever we are taking loan, we have to pay interest. Interest rate is 10%. Okay, I hope this much the cases are clear. Total investment for starting the business is 30 lakhs. Earning before interest and tax, we have taken as 4 lakh rupee. And the tax we have to pay on interest is 30%. And the various cases, case 1, 2, 3. First case, equity only. Second case, there is debt also, 10 lakh rupees. So equity become 20 lakh. And third case, the debt is increased. That is from 10 lakh to 20 lakh. Then automatically equity become 10 lakh. And the interest rate for second case and third case, that is 10%. Now we are doing the EBIT and EPS analysis. The 3 cases we will do analyze, we will compare and we analyze. First case, there is no interest. If there is no interest, so we know that earning after tax, after interest, earning after interest, or we can call this as earning before tax. That also you can, earning before tax. Let's use the word earning before tax because above I have started with earning before interest and tax. EBT, or you can say earning after interest, both are correct. Now nothing is there to subtract, so it will be 4 lakh itself. Now coming into the second case, the interest debt taken is 10 lakh rupees. On this 10 lakh rupees, you can see that 10% of the interest. 10% interest means 10 lakh into 10%. You solve it, you will get it as 1 lakh rupee interest. So just to subtract that. Once we subtract, we are getting 3 lakh rupee earning before tax. The same way, case number 3, you can see that our loan or debt is 20 lakh. So interest on debt, that is 10%, that will become 2 lakh. So once you subtract, you are getting 2 lakh rupee as the earning before tax. So on this earning, we have to pay the tax. So what is the tax amount? Tax rate is already given, that is 30%. So earning before tax, on that we have to subtract 30% tax. 30% tax of rupees 4 lakh, that is 4 lakh into 30%, that is 30 upon 100. Once you subtract that, you will get 2,80,000 as earning after tax. That is EAT, earning after tax. Then we are getting again the case number 2 on 3 lakh rupees, that is the earning before tax. On it, we have to pay 30% as tax. So 3 lakh into 30 by 100, that is 90,000. Here we are getting 2,10,000. That is earning after tax. Case number 3, again 30% on EBT, that is 2 lakh into 30 by 100, that is 60,000. And the remaining amount balance is 1,40,000. That is our earning after tax. I hope you are able to understand this. Once we are getting earning after tax, now we have to find out EPS. What is EPS? EPS means earning per share. Earning per share is equal to, you need to learn the formula. That is earning after tax or the net earning. That also we can say upon number of shares. How many shares are there? Because this entire amount will be distributed among the shareholders. So we should know that what is the number of shares. So number of shares. If we know number of shares, then only we can find out the earning per shares. But you can see that in my case, I did not write any number of shares. But definitely I have written equity. Equity means our share capital only. That is 30 lakh in first case, 20 lakh in second case, and 10 lakh. Nothing, I did not mention anything, or if nothing is mentioned in the case, always consider face value of the share as the face value of the share you have to take as the price of one share. So face value of one share will be always, we know that it will be rupees 10. So here in the first case, let's see that first case, 30 lakh is the investment. So number of shares in case 1, case 2, and case 3. So first case, it is 30 lakh divided by 10. That is 3 lakh rupees. Then after that, 3 lakh. Case number 2, the total equity is, you can see that 20 lakhs. So 20 lakh means we can see 20 lakh divided by 10. If you divide 20 lakh upon 10, you will get a 2 lakh, 2 lakh shares. Here it is 3 lakh shares, second case 2 lakh shares. Now case number 3, the investment is only, our equity is only 10 lakh. So number of shares in case 3 is 10 lakh divided by 10. That is 1 lakh shares. I hope this much you are clear to. Now coming back to our EBIT. Now we need to find out after earning after tax, we have to find out EPS. This is our formula, that is earning after tax upon number of shares. So EPS in case 1, that is earning after share is 2,80,000 upon the number of shares, that is 3 lakh. Once you sold, you will be getting us 0.93. You can calculate. Then second case, 2,10,000 is earning after tax, and the number of shares already we have find it out. You can see that number of shares are 2 lakh shares, and case number 3, 1 lakh shares. So here it is divided by 2 lakh. So here you will get 1.05 as the earning per share. Earning per share. On one share, you are getting, if you invest 10 rupee, you are getting 0.93 as your return. 0.93 paise here it can be 1 rupee 5 paise like that. Now the case number 3, 1,40,000 upon number of shares are 1 lakh, that is 1.4 paise. So this is earning per share. If you invest 10 rupee, because our face value is 10 rupee, then on one. So what it shows, when our debt is increased, first year there was no debt, so there was no interest. Second year debt become 10 lakh, and the third year debt become 20 lakh. Third case. So In first case, the earning per share was less. Less means the satisfaction level of the shareholders or the investors are not good or they are not happy in short. But in second case, it is 1.05. Due to our debt, that earning per share is increased. So they will be little bit happy or happier. And the case number 3, that is 1.4, 1 rupee 40 paise on per 10 rupee. Each 10 rupee they are getting. So they will be the happiest. So here the satisfaction level is little bit. Then here it is, and here it is maximum. Third case, it is maximum. But it shows when we take more debt, our earning per share is also increasing. So it shows that trading on then this process, once we invest the total and in the total investment, if the debt is increasing, that means our earning per share also increasing. And this process or this criteria or this concept is known as trading on equity. So whenever in the examination, there is a question, if there will be a question for 6 mark, explain the process trading on equity through example. The entire case you have to explain. You will assume first the total investment in the capital structure. What about the debt and equity? For that, first you should take a capital structure. Capital structure may first you will decide what is the total investment by your own. You can take any amount. There is no compulsion from textbook only you will take. EBIT, you assume a particular amount and tax rate, then assume 3 cases with debt. The first case will be without debt and the rest of the cases, the debt is increased. Then comes the interest rate. This you have to imagine, you have to assume. After that, you will be doing EBIT, EPS analysis. This chart itself is called as EBIT, EPS analysis. Then EBIT, you have to take for all the 3 cases same because only debt amount is changing. Total investment is not changing, children. So try to understand that point. Then comes EBT. From the EBIT, earning before interest and tax, you will subtract the interest. First case, there is no interest because no debt on that case. And second and third case, the debt is there. So you will subtract interest from that. Then you are getting the earning after tax. After getting earning after tax, you can find out EPS. There you should write the formula. EPS is equal to one entire column. You can write commonly the formulas or you can write as a working note. EPS is equal to EAT. EAT means earning after all profit after tax. PAT in accountancy we call it as PAT. But while solving here we are using as per BST textbook it is earning after tax. Both are same only. Either it is EAT or PAT upon number of shares. Because in accounting ratio, in accountancy, we are taking PBT, that only. So EAT upon number of shares. Here, the number of shares is not given in the case because sometimes this case itself will be coming as a question. So in the question, there may not be number of shares. You will assume face value as the price of 1 share. Always assume because we all know 10 rupees as the face value. Then total investment 30 lakh, 20 lakh, 10 lakh in various cases divided by face value. So you will get the number of shares. So here you have to find out EPS for all the 3 cases. The highest one is 1.4. That shows that equity is increased, sorry, debt is increased, then the EPS also increased. And this process is known as trading on equity. Trading on equity or financial leverage. This entire situation is known as leverage, financial leverage. Financial leverage is better or favorable when EPS is increasing. That means when debt is increasing in the total investment. Now we are moving into the NCERT textbook. I'll share the textbook. You can see the textbook. This is from NCERT textbook only. Here you can see that here you can give me 1 minute. Not able to. I'll open NCERT book. Children, give me 1 minute. Yes. hope this is visible now. Yes. Now annotation is visible. So you can see that NCERT textbook only it is. Here you can see trading on equity. Trading on equity refers to the increase in profit earned by the equity shareholders due to the presence of fixed financial charges like interest. What do you mean by due to the presence of fixed financial charges? That means interest. When the interest will be there? When we take the debt. So the profit will be increased. EPS. Trading on equity refers that increase in profit earned by the equity shareholders. Increase in profit earned by means EPS. EPS will be increasing when there is an increase or the presence of the fixed charges. Fixed charges means interest only. That means when debt is increased, the trading on equity will be always better. Now I'll be showing you a question. After that, let's continue the remaining topic. I hope this is visible. Yeah, there is a board exam question I have taken. You can see the question. Yeah, VO Limited. Yeah, EO Limited is a company manufacturing textiles. It has share capital of rupees 60 lakhs. The earning per share in the previous year, earning per share. Just now we discussed that as EPS. EPS in the previous year was rupees 50. Rupees 0.50. That means EPS was 50 paise per share. For diversification, the company requires additional capital of rupees 40 lakhs. They need 40 lakhs as capital. The company raised funds by issuing 10% debentures for the same. That means debenture means it comes as debt, right? Now, during the current year, the company earned a profit of rupees 8 lakh on capital employed. It paid tax at the rate of 40%. The tax rate is also given. Now, state whether the shareholders gained or lost in respect of EPS on diversification. Show your calculation clearly. Your Limited is a company. They are manufacturing. It has a share capital of already share capital of 60 lakhs. As a part of diversification, company wants to require additional 40 lakhs also. Company raised funds by debt. So total become 1 crore. Total investment is 1 crore now. The company raised funds by issuing 10% debentures for the same. During the current year, the company earned a profit of 8 lakhs on capital employed. It paid tax. So tax rate is given how much? That is 40%, and interest rate is given 10% debenture. That means always in the debenture, the prefix will be your interest on debenture. That is 10% is given, and the earning before interest earned a profit of 8 lakh. That is to be taken as on capital employed. That is earning before interest and tax is also given. Now we have to find out EAT, earning after tax, and on the earning after tax, we know that how to find out EPS. Let's try to find out this, children. So just focus. So you will start the EBIT, EPS analysis. EBI, there are no various cases. There are only one case. So let's see that how it works. EBIT is given in the question. It is already given 8 lakh rupees. First, we will subtract as per the order interest only. Because after subtracting only, we get the proper income. On that, we have to pay the tax. So the interest is 10% and the debenture, the company raised a debenture of 40 lakhs. So minus interest. On 40 lakhs, the 10% become 4 lakh rupee. 4 lakhs you will subtract. That is earning before tax you will get, that is 4 lakh rupee. Now on this you have to subtract the tax rate. Tax rate is given as 40%. On 4 lakh you will subtract the tax, that is 40% tax. 4 lakh into 40 upon 100, that you will get 1,60,000. Now you are earning after tax, that is 2,40,000. Now 2,40,000, you got it. Now you have to find out the EPS. EPS is equal to earning after tax upon number of shares. Number of shares you need to find out. It's not given in the question, but here it is given that share capital is of 60 lakhs. Share capital if it is 60 lakhs. So we know that 60 lakh upon that is how much? It will become 10 rupee, that is 6 lakh. You all know that. So 2 lakh 40 upon 6 lakh. That is 0.4. 0.40. That's all about. So what it indicates? EPS before. That means EPS, the question is that state whether the shareholder gained or lost in respect of earning per share on diversification. Show your calculations clearly. The last year it was when there was no diversification. So now during the diversification, they took the loan. So the shareholders did not gain because EPS has reduced after taking the loan. We know that there is an expansion and all that. It is there. But still, the last year it was 0.50, only equity was there. Now, due to the debt, the EPS is reduced. State whether the shareholders gained also, they did not gain, they lost. Show your calculation. For this calculation, you are getting 2 marks. And if you write whether they gained or lost, they lost because of decrease in EPS from last year 0.5 to 0.40. If you write this statement as reason, you are going to get a half mark. That's all. Then again comes, show your calculations clearly. Also, so calculation also we have done. Then sometimes they may be asking, one more question is here. State any 3 factors that favor. So here you will get 1 mark. For writing the answer, whether they gained or lost, it will be 1 mark. Also state any 3 factors in favor of the issue of debentures. If they issue the debentures, what are the benefits? So here it is given manager, all the 3 points. That is from NCERT only. There are 8 points in NCERT. So you can write any 3 points. So here related to the case study, the company has already issued a capital of 60 lakh for the use of the dilute the control. Because whenever they issue the debt or the debenture, the control diluted from shareholders to the creditors also. Hence to have a certain degree say in management in the company. They will also get a right tax deductibility, interest paid by the company to, because interest on debenture is always a tax deductible. No need to pay tax on the interest on debenture. Therefore, here you can see that interest is paid by the company to its debenture holders is tax deductible. We get the benefit of tax on interest on debenture. The company is paying 40% tax. Therefore, it is better for the company to issue debentures. In that case, it is good because if we issue only equity shares, we have to pay the dividend. Dividend is never tax deductible. Cost consideration. That is again from the NCERT only. Raising fund through debt involves a lot of flotation cost. Moreover, interest paid on debenture is a deductible expense. The interest deducted from firm's earning and then the net amount is used for calculating tax liability. Hence, more debt in capital structure means low cost overall capital. On capital, the cost is less because interest on debenture is always exempted from the tax. But the shareholders are not getting any benefit. That is from the trading on equity. Now we are again back to this. Before we are moving into this financial leverage or the trading on equity, whether it is trading on equities, favorable or unfavorable. We have to understand now that case, favorable or unfavorable. Favorable means in your capital, if more debt is there, and because of that increasing debt, if your EPS, there should be more debt, and because of that, your EPS should increase, then we can say there is a favorable trading on equity. And next is unfavorable. Unfavorable means the debt should be more. Debt will be more, but the EPS will be less. Now, how to understand this case? We can take another one more case. Let's see that case. All cases are everything same. We are going to take our EBIT. EBIT as instead of 4 lakh, EBIT we will take as 2 lakh. Only that difference we are going to consider. Your EBIT is reduced. Now let's see that how it is going to affect. So there are 2 cases. One I am talking about the EPS. Another we will discuss about return on investment, ROI. So first, let's see that EPS. Again, case number 3, 1, 2, 3, all the 3 cases, case 1, then case 2, then case 3. Our earning before interest and tax is now reduced into from 4 lakh to 2 lakh. So interest earning is 2 lakhs in all the 3 cases. That is the only thing we have done. After that, we have to subtract interest. First year, there is no interest. We know that second year, the interest was the structure of the capital changed into debt plus equity. Debt is 10 lakh. On 10 lakh, the interest is 1 lakh. And the third case, it is 20 lakhs. 20 lakhs means 2 lakh. Now let's see that the earning before tax. Here it is 2 lakh itself. And here it is 2 lakh minus 1 lakh. That is 1 lakh. Here nothing. It is nil only. Now we can subtract the tax minus tax at the rate for 30%. So the tax on 2 lakh is 30% of 2 lakh is 60,000. Subtract that. And 30% on 1 lakh is 30,000. Here nothing will come. Let's see that earning EAT, earning after tax. That is only 1,40,000. And here it is 70,000. And here it is, there is no profit only. Okay, earning after tax is not there. Now see that EPS. EPS is equal to earning after tax upon, we can write the formula here, number of shares. Number of shares already we find it out. The first case 30 lakhs divided by 10 rupee. That is 3 lakh. And for second case 2 lakh, third case 1 lakh. The same only. The structure and everything. Only EBIT reduced. Now see that. So here it will become 1,40,000 divided by 3 lakh. Then here it becomes 70,000 divided by, it is 2 lakh. And here it's not possible only. We cannot find out. EPS is not there. So 1,40,000 upon 3 lakh. The answer will be, let's find out. It's 14 upon 30. 14 divided by 30, it is 0.46. And next one is 70 upon 20. It is 0.35. No, it is 35. So here you can see that when the debt is increased, the debt is increased, but EPS is not increased. Why? What is the reason? Here the reason is that our earning is decreased. That is the reason. So debt is increased, our EPS will be increasing. That is a favorable case. But here you see unfavorable means debt may be high, but the EPS is less. That is unfavorable trading on equity or unfavorable financial leverage. Now let us understand the same situation through ROI. What is ROI? So that is another concept, return on investment. ROI is never rate of interest. It is always return on interest. So this there in the accounting ratio, in the profitability ratio, the last one, return on investment. Return on investment. Formula is, what is the formula? EBIT, again, earning before interest and tax upon total investment. Or in the accountancy, we use the formulas capital employed. What do you mean by capital employed? Debtor plus equity. That is D plus E, normally we call it as, or that means total investment. Total investment means always owner's fund plus borrowed fund. That will be included. Now we know that both the cases, let's take that earning before interest. So here I'm talking about the first case only, because second case I explained only for the explaining the purpose of unfavorable trading on equity. The first case is 4 lakh. Both we can take, no problem. 4 lakh upon the total investment. Total investment was 30 lakhs multiplied by 100 also we can take, because return on investment will be always expressed in terms of percentage. So 30 lakhs into 100. Let's solve this. So 40 divided by 3. That is 16 3s are 48. Then 16.67 percentage it will be. It will be 16.67 percentage. Now let's see that what is the rate of interest in the same case 1. Case 1, the rate of interest was 10%. Let's take that also. The return on investment is 16.66 and the rate of interest on your debt. Rate of interest on your debt is 10%. What it shows? Your return is more than the interest rate. So this case is called as your favorable situation of trading on equity, or this is also known as favorable financial leverage position is favorable, or favorable position of financial leverage. Financial leverage or trading. What is actually the word meaning of trading on equity? Whether on our business, if we invest more debt, will the shareholders get the benefit of that or not? So that we can find out through two ways. One is EPS and another is ROI. Here we can see that ROI should be always greater than interest if you want to know that your trading on equity is favorable. Agar aapka trading on equity favorable means ROI should be greater than. Here what is our ROI? 16.67%. Rate of interest is only 10%. So definitely taking more debt is beneficial to the investors and to the organization also. I hope this is clear to you. Now coming back to this again, let's take the case number 2. Case number 2, EBIT. That is our situation 2, not case. Case. The EBIT was given as 2 lakh rupees. 2 lakh is the EBIT. And let's find out, or we can solve it, that ROI is equal to earning before interest, that is 2 lakh, earning before interest, the formula I have written here, upon total investment. In that case, the total investment was 30 lakh only, both the case, only earning is reduced. That is 100, solve it. So here we are getting 6 3s are 18, 6.67 we are getting ROI. And the same case, the debt interest rate was, the interest on debt was 10%. Here it shows that ROI and the interest rate. And interest rate. Here ROI is 6.67 and interest rate is 10%. So ROI is less. ROI is less than the rate of interest. So our financial leverage or trading on equity is unfavorable. So again, I am repeating, to find out this, there are two methods. You have to find out EPS or you can go through ROI. But when we talk about the trading on equity, it is from the investor's viewpoint, ROI also. So depending upon the case, if the cases of the various case with all the total investment, debt, etc. is given, it is which method you will select, that depending upon the case study given in the question paper. Let's discuss one more. One more question, let's discuss. Here you can see that Vedansh Limited has a share capital of 10 million. That is 10 lakh divided into 1 million. 10 lakh divided into shares of rupees 100 each. For expansion purpose, the company requires additional fund by 5 lakh. Management is considering the following alternatives for raising fund. Two cases are given. 5 lakh equity shares, case 1. Already they are having 10 lakh rupees share capital. Each share is of 100 rupee. They want to expand. Just to visualize the case. And two cases are given. That is 5,000 equity shares, or else the second case is 10% debenture of rupees 5 lakh. 10% debenture means the rate of interest will be 10%. Interest rate will be 10% only. Now, the company's present earning before interest and tax is rupees 4 lakh. Earning before interest and tax is given. Assuming that rate of return on investment remain the same after expansion. Their ROI is same. Which alternative should be used by the company in order to maximize the return to the equity shareholders? The tax rate is 50%. Show the working. ROI, there is no change. That means assuming that rate of return on investment remains same after the expansion. After the expansion also ROI is same. So it suggests to the company which two alternatives will be beneficial. Out of these two alternatives, which one will be beneficial, and you have to show the calculation. So just now how we discussed, there are cases given. One is only with equity and another is only with they taking the combination of equity plus debt. So let's do the same in the same way. I hope you will be able to do now this. So case 1 and case 2. So this is called EBIT EPS analysis. We are going to find out the EPS for case 1, alternative 1 and alternative 2. It can be alternative 1 also, can write, because the language which we is given in the question paper should be always used, alternative 1 and alternative 2. Then coming into the EBIT, EBIT is given us how much it is given, 4 lakh, it is given here, you can see 4 lakh rupees. And alternative 1 was issue of shares. So there is nothing to subtract as interest. But in the second case, they have taken it as 5 lakh rupee. 5 lakh rupees, 10% is 50,000 as interest. Subtract that interest. Then you are getting earning before tax. Earning before tax is here no change, 4 lakh itself. And here it will become 3,50,000. Now we have to subtract the tax. Tax rate is given in the question as 50%. So tax is at the rate 50%. So that is 4 lakh on 50% of the 4 lakh is 2 lakh rupee. Here it is 3 lakh 50 is 50% will become 1 lakh 75,000. So we will be getting earning after tax. Earning after tax is 2 lakh here, and here it is 1,75,000. Now let's see that EPS. How we can find out EPS? EPS means earning after tax upon number of shares. In the case number 1, there was initially how many shares? 10 lakh rupees, 100 each. That is 10 lakh divided by 100. If you divide that, 10 lakh divided by 100. So here only I'm doing that. You can get the answer as how much it will become 10,000. 10,000 shares are already there. And again, they issued 5,000 equity shares. That is 5,000. So total it is 15,000 shares. 2 lakh divided by 15,000. So the answer will be 115 are, then it becomes 5. So 50. So 315s are 45. So it will become 13.33. It will go on like that. Now, next case. Second case is 1,75,000 divided by, what is the number? Case 2. Alternative 2 is with the debenture. So we are having only the shares of rupees 10,000. So let's see that 10,000 you take. So you will be getting 17.5. 17.5 was your EPS. So here you can see that debt is increased. In the first case, there was no debt. So EPS was only 13.3. Debt increased means your EPS also increased. So come back to the question. Show the working. Working we have done entirely, and suggest the, if it is and suggest the company which of the two alternative will be beneficial. Now you will be right in the alternative 2, the debt is increased or there is a debt arised in the total investment. Because of that, the EPS also increased in alternative 2. So alternative 2 is beneficial to the company also and to the investors also. So if you solve all the case study, entire case study, there you are getting 3 marks. And for your answer, which one is beneficial? There with the reason you have to explain, there you are going to get 1 mark. So the alternative 2 is beneficial to the company. I hope you will be clear with this case study. So this is one of the case study, and before that another is also given. EPS is given. There you are taking only the given situations EPS. Now there is one more question. Before going into that, I'll be explaining. I'll discuss only 2 MCQs. What do you mean by financial leverage? Financial leverage means increase in total earning per share in the company. Yeah, maximizing equity, minimizing debt. Yeah, balance between equity and debt. Due to financial leverage, that means always trading on equity. Trading on equity means on your business, you have to get always more debt. So the answer is increase in earning per share in the company is known as financial leverage. Trading on equity is what? Always beneficial? maybe beneficial, never beneficial, none of the above. Already I explained both the case. If you take the debt, always it will not be beneficial. It may or may not be, because there I have explained the two cases. In these two cases, first one you see EPS high debt, high EPS. But situation two, the EPS is decreased, even the high debt. So it is always not necessary that if there is a trading on equity, yeah, only there will be increase in the, or it will be beneficial. No, it is not like that. So it may be beneficial, not always, or never also wrong. I hope you are clear with the concept of trading on equity. So take care. Bye bye. I'm giving one homework. You can copy this. You can just click the photo of this and you can solve it. I have written the answer also there. A company is earning before. You can just go through the question. Before interest and tax is 7 lakh. It pays 10% interest on debt. Total investment is 50 lakhs. Advise the company whenever it should include debt or equity to raise its capital. You have to advise the company. Nothing is mentioned about 10%. The tax rate is not given. Before interest and tax, your earning is given. If tax rate is not given in the question, then you will be always advising the company to find out ROI. ROI is equal to EBIT upon total investment. EBIT upon total investment only. So both are given. The investment is given 50 lakhs, EBIT is given 7 lakh. So through that, find out the ROI. So if you find out ROI, always ROI should be greater than the interest rate. Then only the company can prefer the debt. So here they find it out. Then they got 7 lakh upon 50. If you solve it, you will be getting 14 lakh. And after that, see, the answer is given. So always trading on equity. The name, the concept related to this. The concept is trading on equity. Whenever we find out the EPS or the method to invest, whether the debt should be included in the capital or the more equity should be included, that process itself is trading on equity. So both the one more cases is given with a 3 lakh rupee and with 7 lakh rupee. 7 lakh rupee, your ROI will become 14%, and the 3 lakh, your ROI become 6 lakh. There you cannot take the debt. Company has to prefer only equity share capital. So for the day, this much. I hope you are clear with the trading on equity, and take care. See you tomorrow. Bye-bye.